Well, hello everyone, greetings, and thank you for joining us. My name is Hyun-Sung Shin. I'm the economic advisor here at the BIS, and it's my pleasure to moderate the first lecture at the BIS annual conference. Today's speaker is Annette Vissing-Jørgensen of the University of California, Berkeley, and we're especially lucky to have her as Annette is one of the foremost researchers in financial markets. And she's very well known for applying rigorous research methods to really important policy questions. And today's presentation is no exception to that. She'll look at the events of last spring in the early weeks of the pandemic and the stresses we saw in financial markets, in particular the government bond market, and draw some lessons on the role of non-bank financial intermediaries and also the response of the central bank. We're also very lucky to have Andrew Metrick as our discussant. Of course, Andrew is well known as a leading researcher on financial stability, and he's also contributed a lot recently on the policy debates about the events of last year. So I think we can look forward to a really very stimulating lecture and discussion. So without further ado, let me give the floor to Annette. Annette will speak first, and then we will have a short discussion from Andrew, and then I'll open it up for Q&A after that. So Annette, thanks again for joining us, and you have the floor.
Thank you very much, and for inviting me to speak in front of such a distinguished audience. I hope I'm not interrupting anyone's soccer watching. As you know, especially from a Danish perspective, it's been a very exciting tournament. All right, so I'd like to talk about the Treasury market back in spring 2020 and the role of the Fed in straightening things out. So in particular, I want to talk about what I have learned about quantitative easing from studying COVID. And what I have learned is that Treasury QE in COVID was needed for different reasons than it was during the financial crisis. It's been labeled market functioning QE, and I think I'm going to argue that it was done to counter a negative demand shock for treasuries from several investor groups that faced urgent liquidity needs. And I'm going to argue that because it was designed to address those urgent liquidity needs, it works differently. So normally when we study QE, and I've done this myself, we look at announcement effects around key policy announcements. For COVID QE, though, for Treasury QE during COVID, we see yields moving upon purchase, not upon announcement, which means that it's really essential to look at purchases to understand the overall policy effect. Now, I'm going to argue that the reason that we see these large purchases, or also known as flow effects in the QE literature, is that if investors are selling for liquidity needs and the central bank's announcement doesn't change those liquidity needs, in other words, if people keep selling and arbitrage capital is scarce, then markets may only stabilize once you actually buy, and you may need to buy a lot. I'm going to contrast this with corporate QE during COVID, where we mainly see announcement effects and the actual purchases have been small. And the difference between the corporate QE and the Treasury QE, I'm going to argue, is that for corporates, the announcement itself actually did make people stop selling. All right, so that's where we're going. I'm going to do this in 4 steps. First, I'm going to just remind you of the facts from March 2020 in terms of the yield spike in Treasury yields. I'll provide some, I hope, convincing causal evidence that the Fed had a key role in reversing that yield spike. Then I'll get into the economics of why certain groups were selling, and that'll be hopefully informative for us to have a good policy discussion at the end about where all this takes us going forward. All right, so here's the motivating picture. So this is in red, the S&P 500 stock market index, and in blue, the 10-year Treasury yield. And you can see that in February, as the crisis first gets going, both are going down. That's what you would expect to happen in a crisis, with the 10-year going down because of a lower expected short rate and potentially also a lower term premium. The abnormal thing happens from March 9 to 18. The Treasury yield suddenly turns around and goes up by 64 basis points in a short period of time and then reverses back quite fast. This spike happens despite the fact that the stock market keeps falling, indicating that the crisis is, if anything, intensifying. Now, if you look at this across maturities, you can see here in red and orange that you see a sharp spike in longer yields, and in gray and green, you can see that the spike is visible even down in the 2-year yield. So this is really kind of a phenomenon that hit the whole yield curve, but stronger towards the longer maturities. All right, to get us started, let me just do a simple yield decomposition. So think about the nominal yield as the real yield plus expected inflation plus credit risk. I put in red here a measure of expected inflation. This is a market-based measure from inflation swaps. And you can see that there's a sharp decrease in inflation expectations at the same time as we see that spike in Treasury yields. In other words, it's not the case that the nominal yield is spiking because people suddenly think there's supply chain disruptions and we're going to have lots of inflation. And in green is a measure of the government bond, US government bond credit risk from CDS, and it's not moving much. So that means if you look at the expression at the top, that if we calculate out the real yield as a nominal yield minus expected inflation minus credit risk, we're going to get the black line, which is a measure of the real yield, and it goes up by even more than the spike that we saw in the nominal yield. So the real yield spike is around 100 basis points. You would get the same number basically if you had just looked at tips, yields, whether you CDS adjust or not. Now, I should say, since there has been quite a lot of discussion about deteriorating liquidity of the Treasury market during this time, I don't have a liquidity component in my little formula at the top. That's because my blue line is based on the run Treasuries. And while there was some increase in bid-ask spread for those remain quite liquid even during the crisis. So I estimate that only a couple of basis points of the spike in the 10-year can be accounted for by deteriorating liquidity. Here's a graph of the estimated liquidity components. Essentially, that is estimated by running a cross-sectional regression of yields on bid-ask spreads to get the market price for illiquidity, and then multiplying that by the bid-ask spread of the particular security. And you can see in blue that for the on the run, that component is small. Even for the off the runs, it gets bigger, up towards 10, 20 basis points, but it's still small relative to the overall spike in the real yield that we saw of 100 basis points. All right, so it's really about a spike in the real yield. Now, I thought it was interesting to compare this to what happened during the financial crisis. So here are some of the same exact graphs for the second half of 2008. In the top left, you can see that as the stock market starts falling sharply in September and October, we don't see a sharp spike in Treasury yields. To the top right, in red, again, the inflation swap, it falls also during the financial crisis. So that means that we do see an increase in the real yield, as you can see in the bottom left, in either black or orange. But importantly, back then, the real yields start coming down on their own without any intervention from the Federal Reserve. Whereas
Janitza hat, glaube ich, eine kleine Korrektur gemacht. Hast du ja schon nicht gesehen.
So I'm hearing Timon Eilinger speak. Timon, if you could mute, that would be great. All right, I'm going to keep going unless you have something else to say. So the bottom line of this is that COVID was unique in that we see a sharp spike in real yields, and it only reverts, I'm going to argue, once the Fed kicked into high gear and started buying a lot of treasuries. So let's start putting this all a little bit in perspective. So let's think about who was buying and who was selling in 2020 Q1. So in blue here, the Federal Reserve was by far the largest buyer. The Fed's holdings went up from 2.5 trillion to 3.8 in that first quarter. That's 1.2 trillion. Now, some of that was a capital gain since yields were down for the quarter overall. So adjusting for that, in the last column, we have the net purchase of the Fed was just over 1 trillion. The vast majority was notes and bonds. Just comparing to the other sectors buying, just notice how the Fed is really just by far the largest buyer. The second largest is money market funds, but focusing more on the shorter maturities where we didn't see as large yield spikes. Now, this was abnormal. So putting this in perspective, if we look at quarterly Fed net purchases of treasuries, going back to 2000, you see this sharp spike to the right, that's COVID, Q1 and Q2 of 2020. For comparison, you can see those three earlier mountains, those are QE1, 2, and 3. with QE1 coming in at around 300 billion and QE2 and QE3 in terms of treasuries between 8 and 900 billion. So in other words, the Fed during COVID bought as many treasuries in just one quarter. In fact, in just a couple of weeks, I'll show you. They bought as many treasuries as they did in all of QE1 or 2 or 3 in those episodes. Now, who was selling? The 3 main sectors selling were foreigners to the rest of the world at 287, mutual funds at 266 billion, and the household sector, which includes domestically domiciled hedge funds, at 194 billion. That was also abnormal. So looking again at net purchases over time, notice to the left here how the foreigners were not selling during the financial crisis. Neither were the mutual funds. The household sector in the flow of funds, which is what this is based on, is the residual. So that series is a bit more volatile, as you can see to the right. Nonetheless, 2020 Q1 is the largest negative value in the sample shown. Okay, so there's really something special going on during COVID. So let me then try to argue that the Federal Reserve had a causal role in reversing this yield spike. So just to very briefly summarize what the Fed did during COVID, it lowered interest rates, the Fed funds rate, the primary credit rate, and the rate on the swap facilities. And it restarted and introduced also new facilities to stabilize money markets after outflows from prime money market funds. Those are the ones in the US that take some credit risk. And then finally, and I think most importantly, it did bond purchases covering a host of different sectors. So let me focus on just 3 announcement dates. Those are the ones that involved bond purchases. So March 15, the Fed lowered the 3 rates, as I said, and then it announced that it would do at least 500 billion in Treasury purchases and at least 200 billion in MBS purchases. Notice that those are at least, not at most. Okay, then March 23, that's the Fed's, what we could call the Fed's whatever it takes moment. The Fed goes to unlimited Treasury and unlimited MBS, arguing that it would purchase Treasury securities and agency MBS in the amounts needed to support smooth market functioning. I think that's the label, market functioning QE. It also announced 300 billion in lending through various facilities, including corporate bond purchases, which for the Fed was new. And initially, the announcement focused on investment-grade bonds. And then finally, on April 9, there was an expansion of these facilities. The corporate bond purchase facilities were expanded both in size and in scope, now also including some high-yield bonds. Now, if we graph those 3 announcement dates in our first motivating picture, things just don't line up at all. In particular, the 10 years keeps going up by 45 basis points on March 17 and 18 after the first announcement, and then seemingly turns around before the Fed makes its whatever it takes announcement on March 23rd. So what's going on? So I think it's the reason this doesn't line up is, as I argued, that during COVID, QE really worked mostly through purchase effects, not announcement effects. All right, so here's my main picture. So take a sip of coffee and just stare at this one for a while. So in blue, still the 10-year Treasury. In red, the Fed's daily purchases of Treasuries. Notice how the Fed kicks into high gear on March 19, increasing purchases to around 70 billion per day, and keeps that going until April 1. And that lines up perfectly with when the yield turns around on the 19th. Right? So high purchase from the 19th, the yield turns around on the 19th. So I'm interpreting this as saying that the policy lowered yields once the purchases were implemented rather than once they were announced. Now, of course, alternatively could be that the large purchase on the 19th had a surprise element and the market updated and said, look, the Fed is going to do more than we had expected. That probably played some role. However, if you count up the numbers here, you can work out that the Fed was only about 200 billion into the announced 500 billion of Treasury purchases once it increased purchases on March 19. And remember that the 500 billion was at least and not at most. So I think this surprise element was probably less important than the actual purchase effect. Now, of course, there could be some confounding factors, maybe something else stabilized Treasury yields. I think that's unlikely because remember, the stock market kept falling on the 19th and 20th. I've illustrated also here in red that corporate yields went up on March 19 and 20. So there's no suggestion from those theories that there was anything else stabilizing going on the 19th or the 20th. The one thing that might have also played a role is that the first swap lines settled on March 19 for 162 billion, of which 112 billion was with the ECB. That also lines up with the turning point in yields. I think that's of secondary importance in the sense that even though foreigners then would now have a lower need to sell treasuries to raise dollars, it's not like $1 borrowed through the swap facility would lead to $1 less in treasuries sold, since presumably foreigners would also have other things to sell if they needed dollars. So since we don't know that translation factor, the 162 billion in swap lines, one should think of as much less in terms of impact on the treasury market than 162 billion of Fed purchases. Okay, so just remember for comparison that the Fed was buying 70 billion per day. So this is, sort of at most a couple of days of purchases, but given the translation factor is likely much lower than 1, I think this is of secondary importance. Now, in my mind, the other main picture here is really this one, which is a really good one for arguing causality of Fed purchases. And the picture here shows that basically events in the MBS markets looked similar, but moved one day later. So in blue here is a measure of the risk premium of US fixed rate mortgage-backed securities. And in red is the daily Fed MBS purchases. And you can see that everything moves a day later in the sense that the risk premium turns on the 20th, not on the 19th. And the Fed kicks into high gear on the 20th, not on the 19th. And so this, I think, makes it quite difficult to come up with some confounding factor that would have stabilized the treasury market, because presumably that would also have had to stabilize the MBS market on the same days and would thus be inconsistent with this different timing in the two markets. All right, so I've documented the yield spike. I've hopefully convinced you that the Fed had a causal role in turning things around. Let me get into who was selling and why, so we can use that information for our policy discussion once I wrap up. So we had three sectors selling. We had the mutual funds, the foreigners, and the household sector, which includes hedge funds. Let me start with the mutual funds. So mutual funds had large outflows. However, outflows were concentrated in bond funds. Okay, so going into March, bond funds were 4.6 trillion. They had outflows of 257 billion in March 2020. That works out to more than 5% of total net assets. Notice in the top row that the equity funds were much bigger, more than twice as large, but had much smaller had much smaller outflows, even in billion and certainly in percent of total net assets. So this was really an outflow event that was concentrated in bond funds. And as you go down the rows, you can see that there was really across bond funds of all types. At the bottom, I put, so where's the money going? It went into money market funds, except for the prime funds that had outflows, as mentioned previously. Now, so this is interesting, actually. If you look back to the financial crisis, bond funds actually also had outflows during the financial crisis. So to the left here in quarterly data is net inflows to bond funds over time, quarterly. And you can see both in 2008 Q4 and in 2020 Q1, the bond funds lost more than 4% of their total net assets. It is true that in COVID things moved faster, but in terms of the totals, it's actually not that different in terms of percent of total net assets. So now, it's a bit puzzling, right? I showed you earlier that mutual funds did not sell treasuries during the financial crisis, but why not, right? They had large outflows. If, as I'm going to argue, outflows lead to treasury sales, why didn't that happen during the financial crisis if it did here during COVID? So I'm going to give you three arguments that link outflows to treasury sales during COVID. And the key one really is that since the financial crisis, mutual funds have massively increased their treasury holdings. I suspect that they have done this for liquidity risk management purposes in order to be more ready to deal with flows than they were back in the financial crisis. I'm going to provide some statistical evidence that the extent to which funds sold their treasuries was strongly dependent on whether they had outflows, so further linking flows to Treasury sales. And one should also keep in mind that to the extent that Treasury sales were from index funds, then those are mechanically related to flows. All right, let me just show you, I think, a much underappreciated fact actually about mutual funds. So if you look at the figure to the left, it simply shows the dollar amounts of various asset classes held by mutual funds. Now, a lot of people have talked about the black line, which is mutual funds holding of corporate bonds. There has been a lot of discussion of investors reaching for yield into corporates and so forth. There has been almost no discussion of the blue line, which is mutual funds treasury holdings. You can see that kink around the financial crisis that there's a sharp increase in holdings. So just a few numbers. So going into the financial crisis, mutual funds had 173 billion in treasuries. Going into COVID, they had 1.3 trillion. Now, of course, this is partly due to the fact that there's just more treasuries to be held. You can see that in the middle, the total treasury supply has gone up massively. However, even as a fraction of the total, mutual funds have increased. You can see that to the right, the mutual fund fraction goes up from sort of 2.5% to about 6%. So that basically means that once the outflows hit now, the mutual funds had a lot of treasuries to sell. And although those treasuries were less liquid than usual, they were probably more liquid than other funds, other assets that the funds had that they could potentially sell. Now, linking outflows to treasury sales, I'm going to shift to the CRIS mutual fund database and look at whether it was the funds with outflows that sold, and it was. Okay, so fund with outflows had net new cash flows of 615 billion, of which they covered 140 by selling treasuries. Now, interestingly, if you look at the funds that were selling treasuries, they sold 157. They actually sold more than needed to cover the outflows. So the extra, that's those extra 54. This is consistent with very nice work out of the BIS, showing that once funds face outflows, they generally will sell a bit extra in a discretionary way or a precautionary way to essentially be ready for further outflows. Okay, but this links certainly with the argument that the flows caused the treasury selling. You can also do this in the regression specification. Let me not go through the table, but just summarize the main fact, which is that funds that faced outflows sold 18 cents more of treasury securities per dollar of initial holdings than the funds that didn't face outflows. And this is true actually across both bonds, hybrid, and equity funds. All right, so now we have linked the mutual fund outflows to the mutual fund selling, but we haven't really straightened out why were people pulling money out of their bond funds. So I'm going to argue that it most likely were households, and talk through why were households pulling money out of mutual funds. So in the US financial accounts, one can dig up some data on this, and of total mutual fund outflows of 290 billion in 2020 Q1, 280 billion were from households. This is consistent with the fact that households own the vast majority of mutual funds. That differs from money market funds where there's lots of institutional holdings. Now, I don't think the households were pulling money out of mutual funds because they had liquidity needs, even though, of course, they caused liquidity needs for the funds once they pulled the money out. In particular, the timing doesn't really line up in the sense that people were pulling money out too early relative to the liquidity need story, in that the lockdowns had only just started. And at the same time as this all happened, people have been putting large amounts of money into money market funds and bank deposits, suggesting that they didn't have a strong liquidity need. Instead, it seems that what's going on is this sharp portfolio reallocation from bonds into safe short maturity assets. And this is a little bit odd in the sense that if you were trying to de-risk, why not pull money out of stock funds rather than bond funds, since stock funds are much riskier? Okay, so I'm going to propose one possible story, but it's just one possibility. Okay, so I'm going to argue that investment grade funds, let's say, think of a bond fund that's a mix of corporate bonds, MBS, and treasuries, that initially a fund like that appeared to household investors who were reaching for yield a little bit to earn a little bit extra return. But as default risk increased due to increased default risk on the corporates and the MBS, that the fund no longer appealed to those investors. I'm going to call this a disappearing safety effect. And let me just remind you what I mean when I say safety effect. You may have seen this picture from earlier work of mine with Arvind Krishnamurti, where we argue that there's a safety effect in the sense that investors are willing to pay extra for ultra safe or ultra liquid assets. The picture shows the yield spread between corporate bonds and treasuries graphed against the supply of treasuries relative to GDP. And I want you to think of this as a downward sloping demand curve for whatever it is people love about treasuries. So when you're to the left in the picture and there's a low treasury supply, the marginal buyer is the most eager to buy, pushing up the treasury price, pushing down the treasury yield, and thus increasing the spread. Conversely, when you're to the right in the figure, then pricing of treasuries is more normal relative to corporates as you satiate this demand for safety and liquidity. Right, so let's think about this safety effect in the context of bond funds. And I should say that we show in the earlier work that this safety effect is not only something that's relevant for treasuries, it also is to some extent inherited by other low-risk bonds, although, as I'll argue, maybe not as COVID intensified. So let me graph this out in a different dimension. So let's think of price against default risk, and think again of some investment grade fund that holds a mix of various types of bonds. So of course, there should in any reasonable asset pricing model be a negative relation between price and default risk. That's the straight line, the blue straight line in the figure. The safety effect in this graph shows up as a steeper slope with the blue line to the left, illustrated by the segment from B down to A. So think of a bond fund that initially plots at the top green dot, appealing to safety investors. And then as COVID hits, everything moves to the right as default risk goes up. Maybe what was going on was that the fund now slides down that curve to the bottom green line, no longer appealing to the safety investors. Now, it's important to emphasize that I'm not saying that a treasuries only fund is sliding anywhere, in the sense that we have seen that treasury default risk remains low. But indirectly, this will affect the treasury market as that investment grade funds has outflows because the fund no longer appeals to the safety investors and as a result sells treasuries. Now, I don't have a good test of this in terms of the mutual fund flows, but the asset prices are consistent with this interpretation in the following sense. If you look at yield spreads relative to CDS rates for lower risk versus higher risk, there is evidence of this steep slope at the left part of my previous graph, in the sense that for the investment grade bonds to the left, the yield spreads go up much more than the CDS. So that's consistent with that sliding down the curve that I showed you before. But again, this is a suggested story, and we should discuss this more. The other issue that may have kicked in terms of the mutual funds is correlation. Right? So everyone has heard that you're supposed to buy bonds in order to hedge. So in bad times, the bonds are supposed to go up, and that'll make your portfolio safer if you hold a mix of stocks and bonds. That negative correlation broke down. We saw that during this yield spike period, that stocks did poorly and bonds also did poorly. It's possible that investors just looked at this and said, look, this is not what I signed up for. The bonds were supposed to be a hedge, and now they're not, and now I'm just going to get out. I put a quote from the Wall Street Journal along those lines. I cannot think of a good way to econometrically test that, but it is something that we should also discuss. All right, so the second main seller was the foreigners, and let me just dig in with some numbers here. So first, let me show you the split between foreign official and foreign private. Remember, the foreigners sold 287 billion. Of that, the foreign official sector, which is central banks and sovereign wealth funds, sold about 2/3 at 182, and the rest were the privates. So the foreign official played a large role in the foreign selling. Now, why was the foreign official sector selling? Look at the last column here. So the labeling is a little bit confusing, but this is foreign official net purchases of various kinds of US securities. Okay, so the minus 51 means that there was a total reduction of 51 billion in terms of foreign official holdings of US dollar assets. Now, the Treasury sales at negative 196 for notes and bonds are obviously larger than the 51, So what happened was that they were selling not only for what one could think of as immediate FX intervention, but also a bit like the mutual funds. There was precautionary reallocation from treasuries into currency and deposits. You can see those 60 highlighted in yellow at the bottom. There was actually also even some more return-seeking purchases of equity and other kinds of bonds. So the facts here for 2020 Q1 are actually in pretty sharp contrast to what happened in the financial crisis. Notably, back then, the foreign official sector sold agency debt rather than treasuries. There were some other differences, but that was really the main one. There was large selling of agencies rather than treasuries, and actually, on net, the foreign official sector, as we have seen, did not sell treasuries during the financial crisis. And again, there's a parallel to the mutual funds. So the mutual funds had loaded up on treasuries since the financial crisis, and so had the foreign central banks. So the foreign central banks, now I'm showing you the level of holdings, increased their holdings of US assets by 3 trillion since the financial crisis, of which over 2 trillion went into treasuries, meaning that the foreign official sector is now much more reliant on treasuries and less reliant on agency securities. That doesn't speak to the private foreign sales, but if you look at the cross-section of countries, you can get a hint that it must be that hedge funds played a large role. So in particular, here I'm showing you in the second column net purchases of treasuries by country. And in the last column, I'm showing you the change in reserves. And the lines in yellow are the ones that had both large treasury sales and large reductions in reserves. And you can see that there's some rows in the table that doesn't fit that model. Those are highlighted in blue. Those are hedge fund domiciles. So for example, the Cayman Islands was the second largest seller, and there's no role there, of course, for change in reserves. So this is a hint that hedge fund selling also mattered. If you run this in a regression framework, you get a role for both reserves as well as hedge fund domiciles. Now, it's obviously difficult to get a sense of what's going on with hedge funds given the lack of data. I did manage to dig up a couple of data sources to estimate the total likely hedge fund sales of treasuries. There's data from the SEC's Form PF data that actually covers both US domiciled and foreign domiciled, for example, Cayman domiciled hedge funds, as long as they have US investors. Okay, so from that, you can get total long treasury exposure, both in cash treasuries and futures. I found an estimate of the futures position from CFTC data. Long story short, you can estimate the hedge funds net selling at about 183 billion in 2020 Q1. Okay, so that accounts for basically the majority of the foreign private treasury sales as well as the US household sector treasury sales. And there's a interesting literature, a lot of it by BIS folks, as well as some good work by the other folk, the House of Duffy and Barton Kahn from the OFR, that links treasury sales to unwind of what's called the treasury basis trade. This is a simple trade where a fund tries to make money on treasury futures trading higher than cash treasuries. One can think of it as essentially a way for asset managers to rent balance sheet space with hedge funds, in the sense that think of a state and local pension fund in the US, say they want their treasury exposure in the futures market, they can do that by going long futures. That bids up the price of futures, and the hedge funds go short the futures to try to take advantage of this. The reason that the pension fund might want to do this is that, as you know, US public pension funds are allowed to discount their liabilities using the expected return on the assets, which doesn't make a lot of sense, but it means that the pension funds will have an incentive to get their fixed income exposure in the derivatives market. All right, so to sum up here, I have documented large dislocations in the treasury market. I've argued that this really was not about any fundamental problems in the treasury market in terms of inflation expectations going up or credit risk going up. Instead, there was a negative demand shock for treasuries from groups with urgent liquidity needs. I've argued that mutual funds faced outflows and sold treasuries as a result. The foreign official sector sold treasuries for current or potential future FX intervention, and then hedge funds were unwinding leverage trades. The Fed stepped in big time, accommodated this demand shock, essentially replacing $1 trillion of longer and less liquid treasuries with short maturity overnight reserves. And the $1 trillion was really large compared to prior QE events, and in particular was really fast. So the bottom line in terms of what we learned about QE from COVID is that these flow effects or purchase effects are crucial, and that we can't just draw vertical lines in that picture around the announcement effects. We need to look at how much the central banks are actually buying. The key thing here in terms of how much you need to buy, of course, is whether your announcement stops the selling or not. And in the case of the Treasury market, the announcements appear to not have stopped the selling. And as a result, if people keep selling, well, then you have to buy a whole bunch in order to stabilize the market. Now, this is in sharp contrast with how QE usually works, and also with how QE worked in the corporate market in 2020, in the sense that there we see large announcement effect rather than large purchase effects. I put here as a reminder just the 10-year Treasury yield around the main QE1 announcement. Remember, that's when we saw the 10-year move by almost 50 basis points in a short period of time. But back then, this was not about countering a negative demand shock. It was about signaling future easy policy, perhaps increased Treasury scarcity, and so forth, as I have argued elsewhere. Also, in terms of announcement effects, here's a few graphs to illustrate corporate QE in 2020. To the left, I'm showing you investment grade corporate bond returns intraday from an ETF. To the right, I'm showing you high yields, and you can see sharp upward spike in returns around announcements. So there really is a sharp contrast between earlier QE and corporate QE having announcement effects and Treasury QE having purchase effects. And the key thing, as I mentioned, is whether your announcement by itself is enough to make people stop selling, and if not, well, then you need to buy a lot. In the corporate market, it seemed that the announcement was enough to stop people selling. I put here, this is just sort of a pedagogical graph. In green, the Fed's daily corporate bond purchases, and you can see the line is tiny. Instead, what seems to have happened is that the announcement from the Fed was enough to lower the perceived credit risk in the corporate market, and people stopped selling. There's nice work showing that fund flows reversed. Essentially, the Fed provided a tail risk promise, and that calmed things down. And as a result, the Fed didn't actually have to buy a whole lot of corporates. All right, so where does this leave us going forward? It worked this time, but of course, there's a risk of fiscal dominance. As I tried to write out my definition of fiscal dominance versus market functioning QE, it's sort of amazing how similar they sound once you write it out. We could define fiscal dominance as Fed Treasury purchases to keep Treasury yields low, despite a positive Treasury supply shock done due to government pressure. It's almost the same as market functioning QE, right, which is Fed Treasury purchases to keep Treasury yields low following a negative Treasury demand shock. And it's a hard communication task for the Fed and other central banks to explain the subtle difference. Can they explain it well enough in the court of public opinion to avoid fiscal dominance? I put a hypothetical question from a US citizen saying, so Mr. Powell, you'll save the bondholders anytime, but not my Social Security. What was all that talk about the Fed caring about inequality then? Okay, you can see it's a tough assignment. I put also a header here from President Lagarde's troubles when she said that the ECB is not there to close spreads, which, a week later it seemed like it was. So the basic problem here is that government bond markets are so big and so important that it's really hard for central banks not to try to save them, even if that carries a risk of inflation. So final slide is just a sort of laundry list of things we could do instead of having central banks step in, and I hope you'll have some comments on this. The possibilities are to facilitate Treasury trading in crisis through central clearing by, for example, or making the supplementary leverage ratio changes permanent to facilitate others, facilitate financial institutions doing more Treasury trading. A set of proposals to reduce Treasury selling in crisis, for example, by doing more swing pricing for mutual funds. This is not something that's used in the US a lot. Making repo facilities to central banks and dealers permanent, or potentially putting restrictions on hedge fund leverage. But this is just a list for us to discuss. Thank you very much.
Well, thank you, Annette. Thank you, Annette, for setting the stage so well. We have a very rich set of questions for us to debate later. Let's first turn to the discussant, Andrew Metrick. Andrew, are you ready? Why don't we start with your discussion?
Yes, can you hear me okay?
Yes, indeed. Go ahead, Andrew.
Thank you. Thank you, Hyun, and thanks, Annette, for sharing this really terrific paper. What I thought I would do in my discussion is I have three specific comments. They're really more summaries of the things I learned from the paper. There's nothing critical about them. They're things that I learned, and I'm going to try to summarize that. And then I want to turn towards the policy debate. What is this? How does this help us inform policy debates? So really shifting to Annette's last slide. With a little bit of a framing of what this has taught us about regulatory policy and monetary policy, and then talk a little bit about what perhaps the right response is in the policy community. So that's the plan. So first, let me state the three things. I do not have slides, so I like to challenge myself when giving discussions. If I can't remember what it is that I wanted to say about the paper, then there's no chance that anyone who hears me will remember what I had to say. So I'm going to try to do it without staring at my slides. There are three things that I learned that I think are pretty important from this paper, factual things. First is that this was clearly a demand shock. Okay, so Annette does an excellent job in the paper of looking at the alternative explanations. You know, does this have something to do with risk? Is this some very specific type of liquidity shock? It's a demand shock specific to government. To U.S. government securities, so people didn't want to hold them in the amount that they wanted to hold them prior to COVID, and that needed to work its way through the system, and it was hard for it to do it quickly. So that's the first thing. Really, if you think it was something else, if you have some other story to tell, some complex asset pricing story, I think this paper really shoots that down. It was a demand shock. The second is that the Fed, which did a lot of things during the early stages of COVID, we shouldn't get confused about which things worked for which markets. In the corporate market, it was quite clearly an announcement effect, and it went immediately to confidence. The Fed didn't have to do very much in the end. They announced something, but then their actual participation was very minor, and the market reacted immediately on the announcement. In the government market, it wasn't the announcement at all, and the Fed needed to do an enormous actual amount, significantly larger even than the months-long QEs that we spoke so much about and talked so much about. They did in a matter of days. So they needed to actually go in and get involved in the plumbing of the market and go and buy stuff. It wasn't enough just to say we stand ready. Okay, and then the third thing, really set of interesting facts in the paper, is why was this different than 2008? All right, we're always talking about what we can learn from past crises, and clearly things were quite different in 2008. And here, Annette makes several points, the largest of which being there were just a lot more treasuries to sell. Right, a lot about the world had changed so that treasuries, for example, treasuries rather than agencies were held by a lot of foreign central banks. The fact that mutual funds were holding significantly more government securities, in part for liquidity reasons, and in part because of institutional changes in the mutual fund business. There's just a lot more. It's just a much bigger demand shock was going to be much much bigger and more important for these actors because of some ways that the world had changed. That's one. A second point that she raises is about the disappearing safety premium. I would label this a little bit speculative, which she says in the paper. It's very hard to go and test, but Annette is allowed to be speculative about this because she invented this literature. So she's the one who gave us the safety premium in the first place. So she's allowed to speculate that it might have gone away. That's okay. It belongs to her. It's a pretty interesting. It's an interesting possibility. There's so much going on in those couple of days. This certainly could have been one of those things. And then finally, with the discussion of the basis trade, and with the discussion of several other things later in her policy discussion, she points out correctly that there have been a lot of institutional and plumbing changes to this market since before the global financial crisis. In the GFC, banks were perfectly happy to exchange treasuries for reserves left and right without worrying about it. There was really, they had no reason to have preference for one rather than the other. We didn't have a leverage requirement at the time, and they were the primary market makers. The institutional setting had changed a lot by 2020, and it wasn't really banks but others, and banks weren't willing. Usually, the first private place that this can get absorbed in the market, they just weren't willing to do it for some of those regulatory reasons, and that can be illustrated. The whole unwind of the basis trade. It's really less about the sheer amount of money that came in the basis trade, which at 180 billion is not a lot actually compared to the size of this market, but rather a signal of the fact that the market had changed so much that the hedge funds were in that business at all, and it wasn't the banks that were in that business that could absorb it. Clearly, hedge funds can't absorb $1 trillion. They went in the other direction, and there's good institutional reasons why they go in the other direction. We try to be very we try to avoid being pro-cyclical in our regulatory requirements so that we let banks take on a whole lot of extra liquidity when we need them to. The hedge fund world, because of the way the basis trade is set up, is by its nature pro-cyclical, as they have to come up with bigger haircuts and more margins in order to put these trades on. So it's not the way we would want to design it from a regulatory perspective. Okay, so let me transition over to what do I think. So and these are this stuff I didn't know before going in. I have studied this and looked at this pretty carefully. I've read a lot of the BIS stuff, some of which is by Hyun and his co-authors. But many of the facts in this paper were new to me and quite convincing. So how should we think about this? The first point is to recognize that to step back from the finance perspective and take the monetary policy perspective that Annette did towards the end of her talk, and realize that government securities and reserves, so the cash that everyone was running for, and the government securities that they had perhaps on their balance sheet before that, let's not forget that these are essentially the same thing from a risk perspective, in the sense that from a risk perspective, these are just all liabilities of the government. Okay, so and the Federal Reserve, to the extent the Federal Reserve is involved in the business of trading reserves for treasuries, which is good old-fashioned monetary policy, they are really just exchanging one form of government liability for another, and the size of the overall federal balance sheet does not change when the Fed engages in traditional QE. Okay, so the total liabilities if you're worried about the government liabilities and not being able to pay it back, the Fed exchanging short-term liabilities, which are reserves, infinitely short-term, it's the very beginning of the yield curve, for longer-term liabilities that the fiscal authority has issued, does not have an effect on the overall indebtedness of the government. It has an effect on kind of the relative prices between these two things, which historically was the way we did monetary policy before we moved into a world of interest on excess reserves and corridors and things like that. We just went into that market, and that's how we affected it. Now what we've learned, though, is that the traditional way that those markets worked has changed. It's changed for a whole lot of reasons. We no longer have this kind of simple way of going in and out that we understand very well. And instead, when that market starts to seize up, it's usually at a place where the demand or supply curves are very steep. They're not crossing in these nice economics textbooks ways anymore when we start to get near edge points. And so effectively, the government's decision to exchange one form of its liabilities for another can, if we do not have the capacity to make those exchanges, easily get bogged down, and then market players seeing that and knowing that they need one form of government security because they're not perfect substitutes in their use cases, may have to rush into that market. So the analogy that I like to think of here is that the economy is just like a big, huge arcade. It's a big, huge coin arcade, and you need coins. You have to put the coins into the arcade to work. You cannot give the machines bills. They must have coins. Okay, but you come into the arcade, you've got bills in your pocket, cash, hard paper money. That won't go in the machine. So you have to go up to one of either the tellers up at the front or to a machine that they have somewhere and exchange dollars for quarters, for example. And that's a completely normal thing. Nobody is saying that dollar isn't worth 4 quarters. But what can happen, of course, is that at certain times, for whatever reason, there could be a lot of extra demand in the arcade. A lot of people want to come at once and want to start playing games, and they all have bills. And in that world, the pipes that you have to transfer the bills into the coins might just simply not be sufficient. And what we've done since 2008, essentially, is made a much bigger arcade. So we've got a situation where there's a lot more bills that are floating around that are out there. And we've taken away, because it was the banks that were providing these machines that would transfer one form of government liability, government debt, but you can't use government debt to cash out your mutual fund investors when they want. You have to give them the actual dollars. You have to transfer the bills into the coins to play in the arcade. But we took away some of the machines because banks can't do it anymore. They won't do it anymore because of some of the regulatory changes. And now we're a little bit stuck, right? So all of a sudden, in extremis, the way we built set up the institutional structure of the system, people can't get their dollars into quarters. They can't play. Okay, and so then they see that they can't, they may rush and have a run a little bit earlier, not because they're worried about risk, but because they're worried about their ability to actually play this game, okay, which may be paying back your mutual fund investors or stabilizing your foreign exchange or whatever. Now, in that world, how should we fix it? So now we come to the very last part of Annette's slide, and there's a bunch of suggestions on that slide, and that I think accurately describes the universe of things that we can do. A set of those things are change the institutional structure so that we have more pipes again, add more tellers there and more machines so people can exchange the dollars for coins better. I think then we should do some of those things. Probably we've gone a little too far over to the world where we don't have a whole lot of capacity in an emergency. But what the case will be is we will build a lot of excess capacity then, because most of the time you do not need all of that capacity to exchange the government debt securities into reserves or as we say, bills into coins. So it makes some sense to have in place some kind of a facility so that in the tails, in an emergency, we can deal with this. And that's what the standing repo facilities that are suggested by people out there, there are very different flavors that are being suggested for these standing repo facilities. They make a lot of sense. And then it really just becomes a design issue, which is how do you want to design this so that it's useful in an emergency but doesn't appear to create these enormous moral hazard problems. The moral hazard for saying that you'll always take one government liability for another doesn't strike me as a really big one, right? It's kind of all government debt, and so I'm not too worried about that. I think a standing repo facility with some small participation fee and perhaps something that looks a little bit like a small penalty rate would probably suffice to fix this problem without having to make an enormous number of changes to the underlying infrastructure of the market. Okay, I think I had until 11:53 and it's 11:52, so I will stop 1 minute early so that people can ask Annette questions.
Thank you, Andrew. That was great. I think you've also raised some very interesting questions for us. What I will do now is to open the floor to the participants who are actually on the call here. We're also live casting through both YouTube and also our webpage. But let me open the floor to the central bank participants who are on the call. And while we're waiting, I guess, Annette, I think, one question that arises from these kind of events is that perhaps there's also an element of not simply market functioning from a financial stability perspective, but because of the centrality of the Treasury market for the conduct of monetary policy as well, there are also implications of these very large moves, possibly driven by some kind of dynamics, internally, within the market, for the conduct of monetary policy as well. And we've also seen very recently these big moves in long-dated yields, and so if we just cast the net a little bit wider, I think there are possibly some lessons for us to draw from your analysis and also from Andrew's discussion on the conduct of monetary policy as well. But let me turn to the floor. I see. Let me turn to my colleague Stein Claessens, who has a question. Stein?
Yeah, thanks very much, Annette and Andrew. Very nice paper and very interesting discussion. My question, or actually two-part question. One, to create a little bit what Andrew said, your analogy of coins and bills made me think whether the Treasury, in some sense, in terms of its debt management, is an innocent bystander here, and in terms of maturity structure and the like, because when you think about bills versus bonds, and one would have to start to think that the bills is more equivalent to the reserve part than the bonds are. So, question, is that completely irrelevant here, or does it play a role? And then another question, but that I think is more going forward, is really the moral hazard, of course. Several of these proposals that are more of a structural nature, of course, is going to try to reduce that problem. But nevertheless, we're going to have to live with it to some extent, I suppose, with having some interventions. And then the question is a standing facility the least bad? That I hear Andrew saying that is, but maybe Annette has a different view on it. So maybe it will be interesting to hear both of your perspective on these two questions.
Yeah, so on the maturity structure, I think that is a huge deal. Remember back during the financial crisis, as the Fed was buying long maturity bonds, the Treasury decided to lengthen its maturity structure, partly sort of limiting some of the effect of what the Fed was doing. And Larry Summers, I think with Greenwood and Hansen, they have a nice Brookings paper arguing that doesn't make too much sense, that we should have some coordination between the fiscal and the monetary authority. So, to the extent that Modigliani Miller doesn't hold the maturity structure matters, that's going to be relevant this time around as well. And, it's a little bit hard to get a sense of what's happening inside the TBAC when they set the maturity structure. But there's definitely some spillovers in that whatever the Fed does will change effectively the risk management of the TBAC when they set the Treasury maturity structure. On the moral hazard issue, I think I should turn that over, to people from central banks around, whether there's any pressure, from Lagarde's comment that she was not there to close spreads. Certainly there was some pressure there in terms of sort of feeling pressured into buying a whole bunch of government bonds. As an academic, it's harder for me to get a sense of how much pressure central banks feel. But I agree with Andrew that, if QE doesn't do anything in the sense that you're just swapping maturity structures, right, then there's obviously less pressure to do anything. But since we are here discussing QE, it must be that it's doing something. And so then it becomes relevant whether there are these moral hazard issues. But I'm curious to hear what people think about whether they feel pressure to be buying government bonds from the government.
So I agree with what Annette said. I would add that certainly it's the case that, broadly speaking, the shape of the government yield curve is very important. In the shape of the government policy about which things they're going to buy and sell. So the quantity shape of the curve, as opposed to just the price shape, matters a lot. And because the long-dated bonds are not perfect substitutes for short-dated bonds for some applications, and the bonds overall are not perfect substitutes for reserves for others. So certainly, I don't think from this particular exercise we're necessarily learning much about the within the government part of the curve, but that does matter. What I would say is that for this particular event, there seemed to be a sharp demarcation between, and this is from your results, Annette, if I'm reading them right, just from the way you showed what happened in the whole yield curve. It was basically it happened on the whole yield curve, and I think it is that reserves have the ability to do some things that government securities do not. In the financial crisis, actually, it was government securities that could do things that reserves could not for some of the actions that were needed. And that's why we had things like the term securities lending facility in the United States, where people really wanted treasuries. They were willing to give up, they were willing to go and bid and pay higher rates just to get treasuries. So the use case at that time was we needed big, high denomination things to serve as collateral. Here, it was the payment system that people were concerned about breaking down, and the ability to pay people back directly out of mutual funds, things like that. So here, I think the most important demarcation was between the very special thing that only the Fed could issue and everything that the Treasury issued. So everything that the fiscal authority issues with things the monetary authority issues, which is reserves. But broadly speaking, Stein, I think you're making a really important meta point, one for central bankers all over the place. We have seen a change in the way the world works here, in how important treasuries have become as a safe asset. And Annette's work with Arvin really was the first to demonstrate this, but it's extremely important as a safe asset. And whereas it used to be a big deal when the difference between treasuries and dollars were a big deal because one was really safe and used for transactions and the other was not, that's blurring a lot. And so in a lot of different cases, the policy that the Fed has of exchanging one for, or any central bank has of exchanging one for the other, I think is going to be less effective in what it does to the real economy. And that the bigger issue is, what's your safe asset policy? So what total amount when the central banks exchange any type of government liability for a corporate liability, that's a big deal, right? When the Fed said they would go and do that, they were basically changing the size of the federal balance sheet, not just the Fed's balance sheet.
Thank you, Annette. Thank you, Andrew, for that. Just following up on the earlier discussion of the central bank actions here, and then maybe I can turn this question to you as well. There is a traditional distinction between central bank operations which supply liquidity. So it's, for example, some form of collateralized lending, as opposed to direct purchases. I think what your presentation shows is that on this occasion, during that very stressed episode, it was very important that the purchases were, well, it seemed from your evidence that purchases were much more effective. And I'm just wondering, how this links to what Andrew was describing in terms of the institutional changes that had taken place, changing what Andrew had referred to as the change in the plumbing of the system. And I think the lessons from last year, I think, are going to be very informative going forward. As we draw the right lessons. What do you see as being the really important distinction here between lending by the central bank versus direct purchases? Annette?
I think one key difference is that if you have some treasuries and you repo fund them with the central bank, you still have the volatility of those treasuries, right? So they're not really off your balance sheet in that sense, whereas once the Fed buys them, then they're off someone else's balance sheet. And so, there's clear evidence that balance sheets were constrained during COVID, in the sense that the reason that the treasury basis trades blew up was that the futures became even more expensive relative to the cash treasuries, suggesting that there was a lot of people who really wanted treasury exposure in derivatives, not in cash. And so I think that's the key distinction, is who holds the volatility, and that's going to be different between a repo facility and a purchase.
Let's turn to the floor, and I see that President Williams has a question. John Williams. John?
Well, Ewan, I'm a little annoyed. You asked the very question I was about to ask.
Sorry about that.
No, that's fine. It was a great. It was So I just wanted to bring up, and that you've answered it. I think you know, I agree with what you just said, but you know, we were running repos daily at very large scale at the time with quite a bit of take up. And the point you just made, I guess that's where I was going to go, is that there is a distinction especially in middle or early middle March between the liquidity in the market that was being provided with the repos versus actually clearing the market in terms of the Treasury. So I guess maybe my question says, you already answered my original question, and that is perhaps just what are the lessons maybe to take from that beyond maybe some market structure reform? Do you have any other takeaways from that kind of comparison between repos versus outright purchases during March?
I guess for the foreign central banks, maybe the repos, you know, are fine in that I don't think that for them the main issue was they couldn't hold the credit risk of more volatile treasuries. And so that facility, I think, is quite promising going forward. Of course, there's an issue of which exact countries is it open to and so forth, but I think that that one is promising. Whereas if you think about like the broker dealers, the primary dealers, you know, for them, if it really is that they can't take the treasury volatility, then the repo facility, you know, maybe not the right approach. I mean, something I've thought about, but this is obviously a sort of a little bit radical suggestion, is that maybe instead of being the buyer of last resort, the Fed could be the dealer of last resort, in the sense that so far in QE, you know, the Fed is just buying. If Daryl Duffy is correct and it's all just about plumbing and the bonds can't get through the system, conceptually, the Fed could say, look, on Monday morning we're buying and on Monday afternoon we're selling, and then we're going to do the same thing on Tuesday. You know, this is obviously an important issue because now we have all this discussion of how are we going to taper and how we're going to exit. You know, if it really is a plumbing problem, we can exit the same afternoon as we bought in the morning. And so I think that's something really to think about. You know, the people at Vanguard at that Treasury conference said, you know, it wasn't just hard to sell, it was also hard to buy. You know, maybe we should think a little bit more about being the dealer of last resort rather than only the buyer of last resort.
Andrew, anything from you from you on this question? No.
No, Annette got all of it.
Excellent. Well, maybe I can follow up while we are also collecting questions from the floor. And Andrew, maybe I can address this to you. I mean, you mentioned the role of, for example, a standing repo facility to take out that tail risk during these stress episodes. And I think from an ex-post perspective, you know, when things have already, you know, progressed and the stress has already shown up, I think there is a great deal of merit to that. But if you take an ex-ante perspective and wearing your hat as someone who has, you know, studied the regulation and the impact on behavior more broadly. I mean, you mentioned that with government securities, that you know, moral hazard would not be such an issue. But I wonder whether, if we sort of cast that question a bit more widely, and we're thinking about, you know, market functioning, not simply in terms of you know, credit risk, but also in terms of just general you know, stress in the financial markets, which could have broader implications. Do you think that you know, we can still be fairly relaxed in cutting off that tail risk while having a limited impact on the ex-ante incentives? And I'm thinking especially of your, you know, recent paper with Dan Tarullo on coherent regulation. Maybe you can say a couple of words on that.
Sure. So I think it's much more complicated once you get outside of pure government securities. And part of the reason my paper with Dan Tarullo was just suggesting that we pay more attention to the plumbing overall, because we don't have this sledgehammer of a standing repo facility that we can use for all different types of markets, like we can use it for treasuries. But I would caution that I think history has taught us that this difference between ex ante and ex post is not as strong as we would like it to be. That history has taught us that the central banks kind of don't have much choice but to intervene when we have these extreme events. So if we're not willing to say this is an ex ante thing, let's set it up in advance and charge something for it and really be honest about it. Then what we're going to do is we're just going to, every single time it happens, do something ex post, which people really kind of view as being, that's the Greenspan put, right? So I think that we need to do two things. One is to acknowledge that we will end up intervening if something really goes wrong, because we always do. And the political pressure to actually intervene at that moment is such that we will. So we kind of already have something set up ex ante, because there's reasonable expectations that we will intervene in the tail. And thus we need to design a system such that stuff we're going to do ex post gets paid for. So that's number one. Number two, we should pay more attention some of the things that Annette listed for the Treasury market. We can use them more broadly. Overall, thinking about what margining rules are, getting the banks more involved in this business so that they're really the ones with a comparative advantage to take a lot of this liquidity on in extreme events. They're able to do it, and we're not just relying on a long daisy chain that includes hedge funds and a lot of pro-cyclicality. So I think we need to do those two things, kind of clean up the plumbing as best we can. In the Treasury market, I'm just not that worried about the moral hazard. So I think we could use the sledgehammer of a standing repo facility, but a standing facility that took basically a discount window that was open to everybody, not just banks, would be like a standing facility, a repo standing facility for the whole world. I'd be scared by that. I don't think we should be in that business. But we need to build in a little more of a buffer by fixing the plumbing. I don't know if that's an answer to the question that you wanted, or just an answer to a question I wanted to answer, Hyun.
The second is always more important, Andrew. Annette, anything from you on this?
Nothing.
Great. So let me see if we have another question from the floor. So I guess we don't have a question directly at the moment, but if we turn the if we broaden the discussion a bit and think about some of the lessons that are especially applicable to our other members, especially from the emerging markets, who went through the sharp end of this. I think the experience has been that there was that very sharp episode in March when we saw capital outflows, very sharp appreciation of the dollar. But then things actually calmed down quite quickly. There was that big fiscal response as a result of the pandemic, and emerging market central banks were able to keep the domestic bond market on a sort of relatively even keel. I think that's one of the pleasant surprises from the episode last year. But then coming to this year, we've seen a couple of episodes of, especially at the end of February, where we had the so-called taperless tantrum, where we saw the yield curve steepen quite considerably, and what we saw then was that the emerging markets also, especially some emerging markets, also saw a very sharp, steepening of the yield curve. And then in the last few days, we've seen the reverse. We've seen this very sharp flattening of the yield curve. If you were to look at this problem, Annette, from the broader perspective of keeping global financial markets on an even keel, and looking at some of the policy responses that could flow from your analysis, what would be some of the headline pieces of advice you could give to our emerging market members?
This is a little bit beyond my expertise, I should say. I think the general point is that if there's a risk of shock, it always hits emerging markets more. And so to the extent that US policies take out tail risk, it's going to benefit everyone. you see actually that VIX turns around the same time as Treasury yields turned around, and so that will have an indirect effect. I'm not an expert in in flows. Obviously, the U.S. interest rate policy has lots of implications for emerging markets. That's what we saw in the taper tantrum in 2013, and so I would say the risk on, risk off channel is something that U.S. policy clearly contributes in terms of stabilizing things abroad. But as I said, this is sort of outside my area of expertise.
Andrew, anything from you on this?
No, it's even further outside my area of expertise.
So I guess it's closer to what we look at every day. But I guess Annette, with your response, the fact that it was called a taperless tantrum, I think was what was really significant in that that sharp movement in the yield curve happened without any kind of visible, any kind of noticeable change in either the announcements or the policy stance. And I suppose this is where we go back to some of the issues that Andrew was mentioning in terms of the plumbing changes. If the broker-dealer sector isn't able to absorb the changes in the balance between demand and supply, something has to give, and so this is going to show up in price movements. There is a different set of players. There is a different set of channels, the change in the plumbing and so on. And I think so. I think there are many issues that we should certainly continue to monitor very carefully and study. And I see that we're close to the end of this session. So why don't I see whether we have any last-minute questions? But otherwise, it just falls on me to thank you very much, Annette, for that really great presentation. I've been following this particular paper for some time, and I think this latest version really has some really cool pieces of analysis that gives us a lot of pause for thought. And Andrew, as ever, thank you very much for your virtuoso discussion as well. And it's been a great session. And thank you to all the central bank participants who have joined us, and to all of those who are following us on our live feed, both on our webpage and on YouTube. So stay well, and I hope to see all of you in person soon. So thank you very much.
Thank you.
Thank you.